Hello, Anthony.
Hello, Claudine.
We're here today to talk about C Corp Form 1120.
That's right.
It's a little bit of a dry subject.
A little bit dry.
But it's important information.
But we are the most exciting people on earth, and we're going to make it great.
Sparkling.
Sparkling.
Okay. So you have to file IRS Form 1120, which is the U.S. corporation tax return. You're going to report income, gains, losses, deductions, credits, and you're going to figure the income tax liability of the corporation. It must be filed even if the corporation is in bankruptcy or if they have no taxable income.
Mm-hmm. Yeah, that's right. One of the things about bankruptcy is that you have to stay in compliance with the U.S. tax code in order to stay in bankruptcy. And this is even if your corporation is going to file a Chapter 11, maybe they're able to get some of those taxes away. You still have to file. You still have to be in compliance. And part of the deal is, bankruptcy is part of, the benefits of the government. Well, if you want the benefit of the government, you have to do the compliance as well.
Do what they say.
That's right.
All right. So what about due dates?
Okay. So normally, and this is the way it has been, is to due the 15th day of the third month after the corporation ends its tax year. Now, its tax year doesn't have to be its fiscal year. You can pick when you want the fiscal year to end. What you usually see is people do a quarterly end. So March 31st, the quarter ends, June 30th, September 31st, December 31st. And then there's some benefits to that if you have related corporations, sometimes you can offload some income to another one, another one. So you're sort of deferring that. Well, we're going to be talking about audits in another one. There's some things that may benefit, but it also may get a little sketchy. And sometimes having the different ones, it creates so much confusion when you're trying to reconcile bank accounts and you have different years. It can get a little bit much, and it's hard to keep things up here straight sometimes.
Yep. Okay. So now 2017 filing season, for 2016 returns, there is a change. The due date will now be April 15th.
Yeah. So pretty much everything I just said was not valid anymore because March 15th has come and went. And so we're going to be, the next one we're going to be talking about, while it's still true for anyone's this year's, because there are going to be some corporations with their tax deadline ending in this year. Now, what about someone December 30th, if not 31st, if their tax year, it would still be due the March 15th.
Yep.
That one day. That's I don't know. Yeah, I don't know why you could do that.
You could. Now, you can file for extensions. It's Form 7004. Right now, it's a 6-month extension. But next year, when the changes come, it will only be eligible for a 5-month extension, bringing the due date to September 15th. They want to keep it in line with the government's fiscal year. Yeah,
there's a lot of changes coming up next year for filing seasons. We're seeing the FBAR has changed. Normally, it's due June 30th for those with offshore bank accounts of over $10,000 in aggregate. That's coming from June 30th, which is just sort of a date out there, now to whenever your tax return is due. That's April 15th if in the U.S., October 15th if you file an extension, June 15th if you're an expat, December 15th if you are an expat and you get a permissive extension.
Wow.
There's a lot of different ones. So, and also that your 5-month extension, when you're due September 15th, that's really where a lot of the other reporting, where your partnership returns are due as well. So they're just sort of putting on a consistent basis. Most people who are filing an 1120, 1120S, 1065 do tend to go on extension to October 15th. IRS is just going to want to make sure, that sort of month delay allows them to check anything from one to another before they issue a refund or impose an additional tax that may be reversed, whatever it is.
Got it. Okay, now this is a complicated form, and the good news is smaller companies can use a simplified tax return. It's called Form 1120A. If they have to meet these requirements, the gross receipts and total income are both under $500,000. The total assets are also under $500,000, and the company does not own and is not owned by a foreign corporation. We know foreign stuff is definitely different.
And I can tell you exactly how many 1120As we've prepared here, and it's 0. And the reason why is because if it is under $500,000, you're really going to be somebody we're going to want you to do an 1120S. That you're probably unless I could see some instances of a startup C Corp with those sort of numbers where they want to be a C Corp. But for most smaller corporations, it just simply doesn't make sense because when we look at the tax brackets, that under 5, that over the under over, there's a really nasty little envelope of horridness of the tax rate of under 500 but over 75,000.
Yes.
It's one of the worst tax rates out there, so it's really something to think about. If you are filing 1120A, is this a one-off year where something's different? Maybe you had a lawsuit that knocked down your balance sheet. Maybe something your income is off. Maybe people weren't working. But if it's something year after year, you're filing 1120A, you may look into a different structure and converting to an S corp.
Good to know. All right, now there are penalties, of course. We're talking about the IRS. Late filing of return. Okay, so you've got 5% of the unpaid tax for each month or part of a month the return is late, up to a maximum of 25% of the unpaid tax. The minimum penalty for a return that's over 60 days late is the smaller of the tax due, or $135.
I love that.
Random.
$135.
The penalty would not be imposed if the failure to file on time was due to reasonable cause. So again, it's not the I didn't feel like filing.
Not that.
It's
right.
Having a valid reason.
I thought they filed it.
Yeah.
And they didn't. That's a good reason.
All right, so then you've got a penalty for late payment of tax because you have estimated tax payments Form 1120W due by the 15th day of the 4th, 6th, 9th, and 12 months of the year. So if you screw that up, you've got 1/2 of 1% of the unpaid tax for each month or part of a month the tax is not paid, up to a maximum of 25% of the unpaid tax.
So you really could double, if you late file your return, and if you late pay your tax, you could really double any corporate tax that you may owe. And, again, as we look at some of these corporate tax rates, they're pretty horrific. They really can be. For C Corps, they can be really, really horrific. Again, another thing, unless you are, if for C Corps, really makes sense when you're looking to have an employee stock ownership, when you're hoping to be acquired by another corporation, those when it really makes sense, and you really don't have, the S Corp really isn't going to do it. But when you look at, a lot of people get stuck into the C Corp because they thought that's what you do. And they're never really told about the benefits of the S Corp. I see it, even though it's been around forever, not forever, but every day you see somebody like, why are you doing it this way? And I thought that's how you had to do it.
There's always options.
Yep.
As I was reading the IRS.gov website, the Form 1120 instructions, I noticed something that popped up. It said, quote unquote, other penalties can be imposed for negligence, substantial understatement of tax, reportable transaction understatements, and fraud. But it never actually said what those penalties are. And as much digging as I did, I couldn't find any standards.
You do find there are those penalties where if we've looked for them, what are they, and you can't find them.
I almost feel like it's going to be like whatever they're in the mood to.
Sometimes it can be like that this sort of discretion is not so helpful sometimes because you have somebody going off the deep end. One of the other things, too, is that your corporation may have a trust fund recovery penalty.
Yep.
However, that's not really associated with your 1120. When you are assessed a trust fund recovery penalty, that's something that a responsible officer, it's assessed to them personally. And that's actually something that goes to your 1040 account transcript, not your 1120. So if that happens, your trust fund is something that can be fairly nasty. And it's always better to have the corporation, if they can, pay it, as opposed for you paying it from your own personal assets, because you have to pay for that with your post-tax dollars.
Oh,
yeah.
All right.
Yeah, and as we discussed, the C Corp taxation rates of both the C Corp and the combined dividend tax rates, pretty nasty. So if the business can pay for it as opposed to you, that's better.
That's better.
Yeah.
Well, I think we did a pretty good job of dressing up Form 1120.
I'm going to give it a 9.8
okay.
at a 20.
Now, what we're going to do is we are going to be starting, this is the first video in a series of corporations, C Corp, S Corp, LLCs. What you can do is subscribe to our channel. We're going to be talking about tax brackets, audits, all sorts of stuff, and you'll get updates whenever we post new videos. You can comment and like below. You can visit us at irsmedic.com, and thanks for watching. IRS Medic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.